The first type of loan is the conventional loan. The nice thing about a conventional loan is you can put as little as 3% down. There's a special program out there called the Home Ready program, which if you don't make too much based on the area you live, and you meet certain criteria, then you can put as little as 3% down on that loan. The standard down payment for a conventional loan is 5 to 20%, and most people are going to fall into that category. Another advantage, probably one of the bigger ones, is that mortgage insurance is temporary. Once you build up enough equity in your property, you can apply to have it removed. Whenever someone puts down less than 20% on a property, they have to get something called mortgage insurance. And once you build up over 20% equity, you can apply to have that removed. Another advantage to the conventional loan is that it doesn't have to be owner-occupied. You don't have to live there. One of the biggest disadvantages is that it's incredibly credit score driven, meaning that if you don't have a stellar 760, 780 credit, you're not going to get the kind of rates banks out there are advertising. In fact, every 20-point drop from 760 to 740, from 740 to 720, all the way down to 640, you're going to see a worsening of the interest rates offered. Another disadvantage that sways people is going to be how long the waiting periods are after major credit events. If you've had a bankruptcy or foreclosure, you're going to have to wait a bit longer to take advantage of a conventional loan. Next up is subprime loans. There aren't many subprime loans out there these days. They were big back in 2006 to 2007 before the market collapsed, and were partly responsible for the market collapse. A subprime loan is going to be any kind of loan where we are not getting access to the market interest rates. So your hard money loans, any kind of loan where the interest rate is going to vary, your balloon payment loans. There aren't many subprime loans out there, but they do exist. The next one is the jumbo loan. When your conventional loan grows above a certain size, it's different in each county. It becomes a non-conforming loan, and it's in the jumbo category. A jumbo loan is even more stringent than your conventional loan, meaning that you will have to have an even better credit score, and you have to put at least 20% down. And on top of that, you might have to put up something called reserves. A reserve represents a mortgage payment, so you may have to put anywhere from 6 to 12 months of reserves into an account in order to qualify for a jumbo loan. The next three types of loans are all under one category, and that's government-backed loans. There's certain restrictions for government-backed loans. They must be owner-occupied, so you have to live in the home. They must always look at the spouse's income and debt as part of the credit approval process. And there's also property restrictions. The basic property restrictions are that the home has to be move-in ready, water's running, everything works. Now there are three types of government-backed loans. There's the VA loan. Now the VA loan is specifically for our nation's veterans. It's a great loan with no money down and there's no mortgage insurance. Disadvantages are there's what's called an upfront funding fee. All government loans are going to have some kind of government fee associated with them that the government charges to back these loan products. Interest rates are going to be lower on the government-backed loan than it would be on your conventional loan, but they're going to charge you for that right. So on top of the VA loan, there's something called an upfront funding fee, and it varies depending on your discharge status. Next up, we have the USDA loan. The USDA loan is going to be a loan program for those who are geared more towards agriculture, people who are working out in the fields away from the city limits. Pros are a USDA loan with no money down, and the mortgage insurance is going to be reduced. The disadvantages of the USDA loan is that they're only offered in certain geographical regions outside of the city limits. You can go onto USDA.gov and view a map showing the areas that are USDA eligible. Another con is it's income restricted, meaning that you can't make too much money in order to qualify for a USDA loan. The income restrictions are also available on the USDA.gov website. The last disadvantage for the USDA loan is there's something called a guarantee fee. So again, all of your government loans are going to have some kind of fee the government charges for backing that loan. It's a lower risk loan for the bank, and they're going to give you a lower interest rate because of it. That guarantee fee is going to be around 2% of the loan amount, although it does vary a little bit. The last type of government-backed loan is the FHA loan. Now, the FHA loan is going to be the most common government loan that you can take advantage of, and a lot of people are using it today. The advantages to an FHA loan is there's just 3.5% down. In fact, there's not a lot of people who put more than 3.5% down, and you'll find out here why in a minute. So 3.5% down, and they're not as credit score driven as other loan products. I mentioned previously the conventional loans are incredibly credit score driven. Your FHA loan is going to be the opposite. They really don't care much about your credit. In fact, if your credit's over 640, you're pretty much going to take advantage of some pretty good interest rates. So people who are in the mid-600s credit score-wise, this is going to be a great fit for you because you're going to take advantage of a much better interest rate. And the last big advantage is there's shorter waiting periods after derogatory credit events. So if you've had a short sale, if you've had a bankruptcy, if you've had a foreclosure, you don't have to wait as long to take advantage of an FHA loan product. Disadvantages are the mortgage insurance is permanent on an FHA loan. It's never going away. What a lot of people do when they get into an FHA loan and they've got some credit score issues or whatever the case may be at the time, they start building their credit. Then after a couple years down the road, when they have enough equity, they refinance out of an FHA loan and into a loan product that allows them to lose the mortgage insurance. That's a pretty common occurrence with an FHA loan, so it's considered a stepping stone loan for that very reason. The mortgage insurance is going to be on there forever, so biggest disadvantage is permanent mortgage insurance. As with all government-backed loans, the government charges something for that low interest rate, and what the government charges on an FHA loan is called an upfront mortgage insurance premium. It's 1 3/4% of the loan. It's tacked onto that loan when you get it. You don't have to pay for it upfront in cash, but it's tacked on the loan, so that's going to be another disadvantage. Upfront mortgage insurance premium and permanent mortgage insurance. Those are the pros and cons of the basic loans out there. There's going to be down payment assistance programs out there as well, but these are the basics. Every borrower has a unique situation. We all have different credit scores and we all have different debts out there, different incomes we're making, and the right loan product or program is going to complement the uniqueness of the borrower situation. Thank you for watching. I'm Leon Lovelace with Westside Lux Living. If you'd like some assistance buying a house the easy way, well, you're in luck. That's what we do. Please reach out.